Good morning and welcome back. This is going to be a very quick update on what's happening with silver overnight. It's Monday morning. Today is the 29th. We have a major market moving event to discuss, something that unfolded in the pre-dawn hours of this trading Monday. The governing body of the Chicago Mercantile Exchange, the CME Group, has just executed a critical and, frankly, predictable maneuver. They have officially increased the initial margin requirement for trading a standard silver futures contract. The new requirement is now approximately $25,000 per contract. Now, this isn't some minor administrative tweak. It's a direct, calculated intervention into the market's liquidity structure. The immediate effect? A sharp, cascading decline in the paper price of silver that you're seeing on your screens right now. To really understand what's happening, we need to look past those red numbers and examine the mechanics behind this decision. A margin increase is the exchange's primary weapon for managing risk during periods of extreme volatility. By forcing all traders, both long and short, to post more cash collateral to hold their positions, the exchange is essentially forcing a deleveraging event. It's draining liquidity from the market with surgical intent. Think about it. For a trader or a fund that's operating with maximum leverage, a sudden 14% hike in margin requirements can be catastrophic. It triggers an immediate cash call. If they can't or won't inject fresh capital into their accounts by the deadline, their brokers will automatically liquidate their positions. This forced, indiscriminate selling creates a massive wave of downward pressure, which is precisely what we're seeing. The price isn't falling because the fundamental outlook for physical silver suddenly changed overnight. It's falling because the architecture of the paper market is being forcibly recalibrated to purge speculative excess, and most importantly, to protect the integrity of the clearing system itself. The context here is absolutely essential. This margin hike comes on the heels of one of the most volatile weeks in recent silver market history. We saw a breathtaking decoupling between Eastern and Western pricing. The gap between the Shanghai spot price and the COMEX futures price had stretched to previously unimaginable levels. That's a classic signal of a market under severe physical stress, where paper claims are starting to lose their credibility. On top of that, the market was hurtling towards a critical options expiry. There was a massive concentration of call options at the $75 per ounce strike price. Reports indicated over 41,000 of these contracts, which represents a potential claim on over 200 million ounces of silver. That figure absolutely dwarfs the available deliverable inventories in the warehouses. Now, while it's statistically rare for most option holders to actually exercise for physical delivery, the very existence of this massive concentrated risk creates a huge threat to anyone on the short side of those options. If even a small fraction of those contracts were exercised and stood for delivery, it would trigger an instant and unresolvable physical delivery crisis. So, the exchange's margin hike, along with some unconfirmed reports of simultaneous position limit reductions, can be seen as a preemptive strike. By forcibly reducing leverage and speculative positioning ahead of this expiry, the CME is trying to deflate the speculative bubble narrow, that east-west price gap, and mitigate the risk of a delivery failure that would permanently shatter confidence in its contract. While the action is neutral on paper, its practical effect is to give relief to the big players who are short the metal, because it mechanically triggers selling from the long side. Let's look at the immediate results on the global price board. In overnight trading, the silver price on the Shanghai Futures Exchange has pulled back from its recent highs, moving from near $88 back toward the $79 to $80 range. At the same time, the active futures contract on the COMEX here in New York has fallen from above $80 to trade near $75.60. That violent narrowing of the price gap from almost $8 down to about $5 is the most direct evidence that the exchange S action is working exactly as intended. It is reestablishing a fragile link between these two major markets by crushing the paper premium in the West. But, and this is crucial, we have to distinguish between price action and market resolution. This price drop represents a liquidity event, not a fundamental one. The underlying drivers of physical scarcity, the massive industrial demand from green energy and electronics, the logistical bottlenecks, the strategic stockpiling by nations, all of those things remain completely unchanged. All that's changed is the cost of maintaining a leveraged bet on these fundamentals within the paper derivative system. The exchange has successfully reminded traders that while they may have a view on silver, their participation in the futures market is a privilege, one that's contingent on their ability to meet escalating cash demands. This leads us to the most important distinction that every market participant needs to understand right now: the difference between the paper liquidity crisis we're seeing today and the physical delivery crisis that continues to simmer just below the surface. The margin hike solves a problem for the CME. It reduces their immediate default risk. But it does not solve the problem for an industrial user who needs 10,000 ounces of silver next month to keep their factory running. That user doesn't care about COMEX margin requirements. They care about getting their hands on physical metal. This forced liquidation might temporarily push down the paper benchmark price, but it does absolutely nothing to refill depleted warehouse inventories. In fact, by potentially allowing short sellers to cover their positions at lower prices, it might inadvertently ease the pressure on them to source physical metal for delivery, essentially just kicking the can of the physical shortage further down the road. The drama unfolding on our screens is a drama of paper and leverage. The silent, slower-moving drama happening in vaults and on shipping lanes is one of tons and ounces. They are related, but they are not the same thing. So, the strategic interpretation of this event is paramount. A forced liquidation driven by exchange policy is a test of conviction. It separates the speculative, highly leveraged paper longs from the holders whose focus is on the physical metal itself. For that latter group, a temporary dip in the paper price, if it even translates to a lower physical purchase price, might actually present a strategic buying opportunity in an otherwise incredibly tight market. The key metric to watch in the coming days won't be the COMEX futures price alone. It will be the physical premium. That's the extra cost you have to pay for actual deliverable bars and coins over the quoted spot price. If that premium stays high or even continues to grow as the paper price falls, it will be the definitive signal that the physical market remains disconnected and under severe stress. The exchange has acted to protect its own system. It has not acted to bring more physical silver into the market. That fundamental imbalance endures. In summary, what we're seeing this morning is a classic chapter in market mechanics. An exchange, facing unsustainable volatility and risk, has used its rulebook to enforce stability. The result is a sharp, policy-driven correction in the paper price. This provides a temporary break for the embattled short side and narrows those glaring price gaps between global markets. However, it operates solely within the world of financial derivatives. It doesn't plow new fields, open new mines, or unclog shipping ports. The tectonic pressures of global industrial demand, monetary devaluation, and strategic resource competition are still building beneath the surface. The market's attention will now shift. We'll see whether this technical reset is enough to stabilize conditions through the option's expiry, or if the physical market, against reality, will once again assert its dominance over the paper realm, once this forced liquidation runs its course. The immediate storm may be passing, but the climate that created it remains completely unchanged. Thanks for tuning in. This is a fast-moving story, so be sure to subscribe and hit that notification bell so you don't miss our next update. We'll be tracking this very closely. See you in the next video.